Greetings, everyone. Scott Richardson and Dan Brown from Richardson Capital Management here to provide the November 2023 Economic and Investment Update. I'm pleased to report that this update is one of the most favorable ones we've had in the last several months, as the financial markets performed quite favorably during the month of November. That followed 3 straight months of negative returns in the stock market, so it was a nice change of pace to have the financial markets performing favorably. Stocks were up anywhere between 8 and 9%, depending upon the sub-asset class, and fixed income was also up about 5%. So solid returns in both stocks and bonds. The key driver for the performance in both of those asset classes was the fact that interest rates declined. So rates came down and the financial markets started to perform more favorably. To provide us some more details on exactly how that played out, I'm going to turn things over to Dan.
Thanks, Scott. So to provide a little bit more context about those topics, we've written pretty extensively over the last couple of months that really the only thing that mattered to the financial markets really was the direction of interest rates. So a couple of months ago, we showed a graph, 20-year graph of the U.S. 10-year Treasury rates, showing that that has gone up a fair amount over the last year or so, after declining for the first probably 15 years, which was a favorable tailwind for the financial markets. And year to date, we've seen interest rates rise pretty dramatically, especially in that August through October time period. And what we saw from that is negative returns both from stocks and bonds over that time period. And a lot of that changed, that narrative changed in early November, primarily around the November 1st Fed meeting. And what we saw over the course of November was interest rates drop pretty rapidly. And as you mentioned, financial markets responded both very favorably both for stocks and bonds. And what we heard at the November 1st Fed meeting is that the Fed, at least the investor takeaway was that the Fed was going to probably be on pause for a while here, and they could be done with their interest rate hiking campaign that began in March of 2022, that took Fed funds interest rates basically from zero all the way up to basically 5.5%. So we see inflation readings continue to cooperate and trend lower pretty consistently. So investor sentiment shifted quite a bit in early November, and that continued throughout the month, where to start the month, investors were thinking the Fed could raise maybe one more quarter point increase yet this year and keep rates pretty high for a long period of time. And again, with the cooperating inflation rates and talk from the Fed, that sentiment changed pretty quickly throughout the course of November, thinking that the Fed might be done with interest rate hikes and actually could begin cutting interest rates as early as the second quarter of next year. So again, interest rates and financial markets responded very favorably. And to put our spin on that, we think that investors have been trying to anticipate those interest rate cuts for quite a while now, and we think it might be a little bit premature to still anticipate interest rate cuts as early as the second quarter next year, with the healthy unemployment rate, strong economic growth, and investors anticipating double-digit earnings growth from corporations next year. So Scott, with all that, do you want to provide an outlook for our clients?
Sure. So I think our big picture takeaway would be the fact that we're feeling optimistic about the fact that economic growth is still remaining pretty strong, unemployment's still pretty strong, and inflation is starting to moderate and it's been pretty consistently moderating. So it's looking more and more like there is a good chance that we could have what we call that soft landing, where we could get inflation under control without throwing us into a severe recession. Um, I think 12 months ago, we all thought that was probably highly unlikely. Seems like that's becoming more and more of a possibility and maybe even a probability, which is great. That said, as Dan mentioned earlier, the financial markets we think are probably maybe just a little bit ahead of themselves. Baking in the fact that they think interest rates are going to get cut early part of next year, whereas I think we're more of the opinion that they're going to keep rates higher for a little bit longer than that. If growth continues to hang in there and we don't have significant increases in unemployment, they really don't have any real impetus to decrease the interest rates. And so while we think things are looking optimistic and we're going in the right direction, we probably think the financial markets are a little bit maybe ahead of themselves. And with all that said, I think right now we're of the opinion that we still think it makes sense to be a little defensive with the portfolios yet. Um, That's in good part driven by the fact that we can get 5.25% on funds in a money market fund right now. So if we got a little bit of dry powder, played a little conservative, we're still getting 5.25%, given all the uncertainty going on with the economic environment. And obviously we've got issues going on in the Ukraine and the Middle East. We just think that's probably still the prudent approach till we get even a little bit more clarity on exactly where the economy's heading. So for now, we're standing pat, but we are, I think, getting more and more optimistic as time passes by here. So with that, I want to thank everybody for joining us. As usual, if anyone has any questions or concerns, please don't hesitate to reach out to all of us.